Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, November the 2nd, and want to take just a brief minute as markets continued to sell off last week, ending the month of October, unfortunately, on a negative note. But we had the S&P 500 down 2.53% last week. You had the mid-cap index down worse, down 2.78%, and you had the small cap index is measured by the S&P 600 down 2.20% on the week. And it was all on the back of interest rates. As interest rates moved higher last week, the 10-year got close and for just a brief tick traded above 5% as fears over the Fed continuing to raise rates higher for longer. Some auctions going. I won't get into all the weeds about the auctions that the Fed was doing and the Treasury was doing that had investors kind of spooked about the federal deficit and interest rates moving forward. But fast forward to this week, we did get the Fed Bank meeting. Federal Reserve had a 2-day meeting this week where they met on Tuesday and Wednesday. And investors were really, really pleased with the corporate earnings that we've gotten so far this week and the commentary that we got from Chairman Jay Powell. Chairman Powell had about 4 or 5 times yesterday afternoon to be what we would consider hawkish or negative, kind of where the Fed had to do more or things along those lines that the market would take hawkish. And typically when he's more hawkish, you see markets sell off and interest rates move higher. Well, as we're speaking right now, the 10-year has fallen all the way down to 4.66%. So remember, last week we were touching close to 5%. We're all the way down to 4.66% on the 10-year Treasury right now, which has allowed markets to really recover this week. The earnings that we're getting this week are very good as well. And what's important about the commentary from yesterday's Federal Reserve Bank meeting and what Chairman Jay Powell said is he's basically putting the Fed on the back burner. And for the past 18 months, this market has been driven by the Fed and Fed actions. And now we can get back to earnings and market fundamentals and the things that really, and the economy and what's really driving equities moving forward. But I wanted to spend a little bit more time on something I touched briefly on last week, which was quantitative tightening and the liquidity that the Fed is pulling out of the system, and really wanted to go into a little bit more depth and detail there. So quantitative tightening is what the Fed does to pull money out of the system. So for the past 13 years, we've been doing quantitative easing, and a good example of this would be when we got into the pandemic in 2020, in March of 2020. Part of quantitative easing is the Fed will buy bonds. They'll buy treasuries, they will buy mortgage-backed securities, and they bought a lot of mortgage-backed securities during the pandemic to support the housing market, to keep rates low and to keep interest rates low on treasuries, on bonds, and to keep interest rates low. So they're pumping money into the system. So they're buying and they're putting money in to the system, putting the bonds on their balance sheet. So now there's more money in the system. Well, they're doing the inverse of that as we speak, and that's quantitative tightening. So now the Fed went from before the pandemic holding about $4 trillion worth of bonds to $9 trillion worth of bonds during the pandemic, and now they're trying to get back down. And they've sold about $1 trillion off, so there's about $8 trillion left on the balance sheet. But remember, as I said earlier, when they're buying bonds, that's money coming into the system, but when they're selling bonds, that's money coming out of the system. And that's what they're doing currently. And with interest rates at where they are, you have a lot of liquidity pumped into fixed income vehicles. So if you look at the actual line, the AD line, or the overall volume in equity markets, it's actually very light compared to what its historic normals are. And what that's doing is causing there to be a lot of volatility in the equity markets, both on the up and down side, as stocks are more thinly traded. The more a stock is traded and the more volume, the tighter the spread is on the bid ask, and the equity markets. So the liquidity being pulled out of the system and investors being cautious in fixed income, there's just not enough money to go around to support things. But now that the Fed's on the back burner, we have 4.9% GDP growth for the third quarter. The employment cost is coming down. Inflation is coming down. Investors are starting to say maybe now's the time that we start to see that broadening out in the equity market as we get these earnings reports in from these cyclical companies that are telling us that it's okay. They're earning, and they're earning more year over year. Revenues are growing for the most part year over year. Some are issuing cautious guidance, and those who issue the cautious guidance, your stock is getting hammered in the equity markets. But if you have questions about how to navigate this time through quantitative tightening or what that means for you, feel free to give us a call. We'd love to talk to you. You can reach us at 904-346-3460. Or as always, check us out online at www.riverplacecapital.com. Have a wonderful rest of your week, everyone. Thanks so much for watching.